What's up, guys? So this is going to be an overall market update video. We'll talk about inflation and interest rates and why asset prices across the board are falling. So we'll kind of break it down piece by piece. And right now, it's very evident to see that a couple of things are happening that we know for sure. Thing number one is inflation's here. It's been here for a while, and it doesn't take anything more than a little bit of common sense. If you go to your local grocery store or your favorite diner and you see that prices have gone up exponentially. And we've kind of seen this since the pandemic. And at first it was, blamed on the fact that it was a supply chain problem. And, obviously there was pieces to that too, where, less people were working, therefore less things were being made. And therefore the things that were being made were going to cost more because it costs more to move those things. And now, with gas going up, obviously with the whole Ukraine debacle, it makes things even more expensive. But the biggest layer added to that is money circulating, in our economy, which has been well over a few $1 trillion that we just pumped into the economy and said, hey, we're going to keep us alive through, the vid crisis. And now we're dealing with kind of the repercussions. So inflation's around 8%. So the government says. So in reality, it's probably closer to like 15, maybe even 20 in certain cases. And, we've seen everything during that time just kind of balloon up, right? And I'm not saying necessarily that every single thing was a bubble, but we definitely saw all stock market across the board go up, housing prices go up, even luxury watches go up, literally anything. You could have thrown money at anything from 2020 until middle of 2021 and you would have made money. And now we're seeing kind of like the repercussions or the negative effect of inflation, right? So how can you really combat inflation? So there's a few things. The whole point of the rates going up is you're trying to control consumer behavior, right? So let's break that down a little bit. Like, obviously, the way to control inflation through an economic lens is you have to contract the money supply, right? So therefore, stop printing. If you raise rates, on lending, which is what the Federal Reserve is trying to do, that will directly impact consumer behavior and therefore it will stop consumer consumption, right? Because at the end of the day, the biggest thing is if we keep printing money and we just keep giving everybody a stimulus and prices keep going up, we are just going to destroy people that have been saving money their whole lives. They're just going to get annihilated. And eventually you get to a certain point where wages can't even keep up with new rising costs. So to kind of nip it in the bud in the beginning, we need to stop printing money. And then when you raise interest rates, what happens? Well, obviously, the borrowing payments, go up. Like, let's use like a home, for example. If your new interest rate is at 6% on a $500,000 home, obviously your payment is double. It'll be closer to $3,000, right? And also, a large portion of American or the middle class's disposable income when it comes to them investing in stuff and wanting to do renovations and really add growth to the economy comes from refinancing. So if rates go up, not that many people are going to be jumping up and down to refinance because their payment will be higher, right? And also with rates going up, if I can't afford a $3,000 payment, eventually some asset prices like houses are going to have to come down until I can afford it. And that also impacts refinances. But the key behind it is to control consumer behavior for consumption. For example, if you still bought a $500,000 home and your new payment is $3,000 versus it would have been $2,000, that means you're having to pay an extra $1,000. So that $1,000, instead of it going into you getting dinner or possibly buying a new car or buying a new barbecue grill, you're kind of forced to step back from that. You're kind of forced not to spend money there. You're forced not to go to take a trip to Vegas or go plan that family vacation because now housing is a necessity. You need to make sure that's taken care of first. And as you can see, that helps bring demand down. So the supply stays the same, but now in this case, demand meets it. It meets right in the middle, and you kind of get like an equilibrium. And then that when that point happens, you'll get a stabilization of inflation, right? Because what happens is if you have this much demand for something, sloping here, and there's only this much supply for something, that price, on this end is going to go higher up on that graph. Like if you're looking at like right in the middle, that's where it should be. As like supply shrinkens, right? So supply goes up, and or demand goes up, whatever goes up, that price is going to go up. But as you start bringing things down, it'll come back down to an equilibrium, which is a middle, which is a fair price, all the way around. And the only way you could do that, and the only way you could bring demand down in this case, because we're still going to want to eat out. Who doesn't? We're still going to want to take vacations. Who doesn't? But the only way you could force that demand to come down is you physically charge people more for just living. And therefore, they don't have the ability to really go out and spend that extra money, right? If you can't go make an extra patio in the backyard, now that wood price starts coming down. If you don't want to redo your cabinets now because you're like, I'm going to hold off, wood price starts coming down, right? And tile prices start coming down. And even, on the credit cycle side of things, like if we can't afford, brand new Chevy Suburbans at $100,000, they can't charge $100 because there's not going to be that many people that are willing to pay for them, right? But what does that lead to? Ultimately, that leads to a recession. It's a forced recession. It's a slow down because the market right now is running so hot. We're all running so hot. If we know the negative side effects of running too hot, you devalue everything. So what happens is it's a natural recession. Like I just said, more people can't afford to go buy a new $100,000 Suburban. So not only does the price start coming down, but then Chevy says, hey, let's not make 100,000, Chevy Suburbans. Let's make 50,000. Okay, well, what happens? You start laying people off. Mortgage lenders, hey, we're not doing as many refinances. We're not selling as many homes. Let's fire some staff. And as you can see, everything starts coming down. And if a company is like, hey, we were going to go open another office, or we were going to expand. Hey, lending's expensive and our actual customer base has shrunk a little bit. Let's fire people. Let's not expand. The whole economy starts contracting. And this is what we've all known. Like our parents have known this. Us as millennials, we've never had a true credit cycle because every single time the Federal Reserve would just come in and do quantitative easing and artificially keep interest rates low. And we just kept this gravy train going. And now inflation is out of the bottle, right? They were able to cap inflation at 3%, even in 2019 before COVID. But now it's at 8%. They can't hide it anymore. They forced their hands. We're forced now to raise those rates because that's the only way that we could control inflation. Because remember, stop printing, increase interest means you force consumers to stop consuming. And you're forcing yourself into a recession. Once things stabilize, like if we could cap inflation, at 10% or 8%, and if interest rates, the Fed discount rate is at like 4% or 5%, which means home loans go to 7 or 8%, and everything just evens out for a minute. And for a minute, I mean like at least 3 months, 6 months, 1 to 2 quarters, and that's what's defined as a recession. A recession is, I think it was 2 or 3 quarters of economic decline. So for GDP, so if we stop producing less things 3 consecutive quarters, we're in a recession. It means the economy is shrinking. It's regressing. But once we have inflation locked in at 8%, or 10%, whatever it's going to be, for at least 2 to 3 CPI reportings, or 1 quarter or 2 quarters, right? I would expect the Fed to raise rates a little bit more, right? And then you'll see inflation start to drop. That's going to be the key. The key is going to be the Fed's going to want to get inflation under 5%. Probably back down to 3 is what they're hoping for, but definitely under 5. Now, once it gets under 5%, I don't know after how long that will take. It might be a whole nother quarter. It might be a whole nother 3 to 6 months. We're talking about a whole year now. But once we get to 5% and we maintain 5% for at least 2 to 3 months, 1 quarter, then the Fed will say, okay, whew, we got a cap back on inflation. Rates are kind of high. Businesses are slowing down. Our economy's in the shitter. Let's start a new credit cycle. Let's start things back up again. So how is that going to start again? It's going to start again by then them lowering interest rates a little bit, and they're going to keep a close eye on inflation and rates. So they might go down a quarter basis points. Look at inflation. Okay, inflation's not being checked that much. Drop it another quarter. Oh, drop it another quarter. You get it? And if we could keep dropping until things balance out again, we'll start to be able to grow again, because then all of a sudden we can afford things again. We can afford home payments again at certain prices. We can afford to take loans out to start businesses again. So that's really like the cycle we're going to. So the market's like, what's going to happen is, why is tech selling off? Why are these companies selling off? Because we all know that interest rates are going to have to go a lot higher in order to stop inflation. So if you had $100,000 sitting on the side, why would you buy a company right now that you don't know if it's going to be profitable or not? Especially in tech, like some of these tech startups, they're not profitable for decades, right? Not everyone is a Facebook and a Google that still make crazy amount of money. Most companies report negative earnings or little next to nothing, and they're burning through cash because they want to grow and gain market share. And then one day they'll give you a profit. But if you as an investor, you're like, why would I park my $100,000 in that? Like, let's take DraftKings. Let's take DraftKings, for example. I love DraftKings. I wish I had money right now sitting, because I would love to load up. I think it's going to go a little bit lower because DraftKings isn't reporting a profit. Now, on the books, it's still showing at a loss or whatever, but what they're doing is they're taking all their profits and they're putting it back into the company. They're still growing. And you as an investor, you're like, why would I park $100,000 with DraftKings? Yeah, I love the company. Yeah, I think one day it's going to be very profitable once they got market share or whatever. When I know interest rates are going to go to like 3, 4%, 5%, I could park my $100,000 there. I'll make a guaranteed $5,000. I protect 100% of my my $100,000, and I'll reassess the situation. And if DraftKings goes to like, from 14, 15 down to like $10, maybe that will be like, you know what, that's worth the risk for me, right? And you could do that with every other company that's out there. And that's what's going to be happening, is a lot of people right now are going to be saying, why am I going to take this risk? Let's see where interest rates go. And if I'm going to get paid 4%, 5% to just park my money in the bank, or just to buy a 13-week treasury or a 2-year treasury, I'll sit out for 2 years, pay me $10,000 on my $100,000, and I'll come back and I'll see what's up, right? And if I was going to be in the market right now, because I did have a few people DM me, it's like, well, what should you be buying the dip? What should you be doing? I highly encourage you, if you don't understand what put options are, I posted the video. If you go to my page, you go to the videos, you click series, and you go to options, or just scroll down, you'll see I posted the video that says put options. It's like 30 minutes long, and it explains exactly what put options are and exactly how you could use them. That's what I would be doing right now, is I would be selling puts on companies that I really, really like. For example, DraftKings. DraftKings is like $15 right now and some change. I would probably be selling the May, 27th put, or like the end of May put, for like $14 and collecting $1. And if it falls, I'll make the $1. If it doesn't, I just collect that premium and I'm waiting. But a lot of people right now have pulled money out, and as rates continue to go up, a lot more people will pull money out, and they'll be on the sidelines, and they're just going to wait. And that's why I always laugh. Like, at the end of the day, cash is king. It's always been king. Like, people that say, cash is trash are people that have so much money coming in, they have to put it to work. So to them, it's trash. But regular people like me and you, cash is always going to be king, because we're always looking for opportunities. And if you have cash, you have the opportunity to take advantage of an opportunity. If you have no cash, you're kind of just stuck holding and waiting. Anyways, I hope this helped, guys. If you like this video, please share it. And appreciate you guys liking, sharing, and following my content. If you have questions, go ahead and comment, and I'll try to answer them the best I can.